How do interest rates impact inflation in Canada? Interest rates can have a significant impact on inflation in Canada, as they do in many other economies. The relationship between interest rates and inflation is complex, but it generally works in this way. Interest rates as a policy tool. In Canada, the primary tool for controlling inflation is the interest rate set by the Bank of Canada. This is known as the target overnight rate. When the central bank wants to influence inflation, it adjusts this interest rate. If it wants to cool inflation, it'll raise the rate, but when it wants to raise inflation, it will lower the rate. There's an inverse relationship, typically an inverse relationship between interest rates and inflation. When the central bank raises rates, it becomes more expensive to borrow money, leading to reduced spending and investment, as we see with the slowing of the housing market and the vehicle market, etc. This can slow down economic activity and reduce inflation pressures. Conversely, when interest rates are lowered, borrowing becomes cheaper, encouraging spending and investment, potentially leading to higher inflation and bubbles like we've seen in the Canadian housing market. Expectations. There's no shortage of news predicting if inflation is going to rise or is it going to lower and how rates are going to affect it. Interest rates can also influence inflation expectations. If the central bank consistently maintains low interest rates, people and businesses may anticipate higher inflation in the future, which can become a self-fulfilling prophecy. Conversely, raising interest rates can signal a commitment to controlling inflation, influencing expectations downward. And what's going on in Canada, especially right now, is a bit of a teeter-totter when it comes to people renewing their mortgages and trying to predict what's going to happen in the next few years if they're going to end up having to renew their mortgage at a triple or even higher interest rate that they took it out in the first place. Exchange rates. Interest rates can impact exchange rates. When a country's central bank raises rates, its currency can become more attractive to investors seeking higher returns, which can lead to an appreciation of the currency. A stronger currency can reduce the price of imported goods, putting downward pressure on inflation. Now, I don't know if you noticed, but usually when Canada raises their rates, the US is in step, or vice versa. And this is because people who deal in currency exchange are looking for a higher return on their investment when it comes to that sort of thing. So the central banks try to work in step, especially in North America. Credit and borrowing costs. Changes in interest rates affect the cost of credit. Higher interest rates can lead to higher borrowing costs for consumers and businesses, reducing their ability to spend and invest. Lower interest rates can stimulate borrowing and spending. And we've seen this for sure after the 2008 bank problems in the US, where interest rates were lowered down to next to nothing. People could afford a much larger house and a much larger mortgage because of the fact that free money, paying 1%, made the payment very affordable on a lot larger of an asset. And also, again, when interest rates were lowered in the pandemic, we had the same effect. Businesses would borrow in very high volumes because money was cheap. People would borrow money to invest in the stock market. People would buy RVs, boats, and anything else they could get their hands on because money was basically free to borrow. And all of this created the huge bubble that we see happening now throughout a lot of the world, and especially in North America. The housing market in Canada. The housing market is particularly sensitive to interest rates. Lower interest rates can lead to increased demand for mortgage and housing, potentially driving up home prices. Rising home prices can contribute to overall inflation. Now, when you think about this, our central banks are trying to what they call make houses more affordable in Canada. And the tool that they're using is raising interest rates. And they think that this is going to drive prices down to make them affordable again. But in my humble opinion, what is happening is there was a lot of corporations and other individuals that raised a lot of capital when money was cheap, whether that be selling bonds, issuing more stock in their public company, etc. And now they're sitting on a war chest of excess cash. And it's these folks that will step in and keep buying these houses even at these elevated prices because they can get enough rent from these investments to make it worthwhile. Yeah, Joe Blow and Mrs. Blow that are trying to buy a house are suffering because the price of housing is so high as well as rates being so high. But unfortunately, there is enough foreign money and corporate money to keep most housing markets in larger cities to keep the prices elevated on these houses. And also, too, politically, there's a lot of seniors that own houses, and there isn't a government in the world that wants to see house prices crater completely because all these older folks won't vote them in the next election if their biggest asset loses its value in extreme amounts. One thing that folks don't really realize as much is Canada is a significant exporter of commodities such as oil and metals, things like different minerals for the manufacturing of batteries as well. So commodity prices can be influenced by global interest rates, which in turn can affect Canada's inflation rate. And Canada relies on a lot of GDP from these different components. It's important to note that the relationship between interest rates and inflation isn't immediate. They say that there's a 6 month to a year and a half lag between raising a rate and it bringing down inflation. Now, central banks like the Bank of Canada carefully consider these factors when setting interest rates to achieve their inflation targets. However, something that we have going on in Canada that isn't the same as a lot of countries is we have a very, very high immigration level. Last year, we brought in over 1 million new Canadians. And what this has been doing is creating a very high demand for things like housing and household items and clothing and rental properties or being able to rent a place to live. And the bank is kind of stuck between a rock and a hard place because they want to keep raising interest rates to bring down inflation, but we have such a high immigration causing this very high demand outpacing supply. But the other thing is that we need a very high immigration level to sustain the government spending as well as pay for future government expenditures for things like government pensions and other expenditures. In summary, interest rates in Canada are a vital tool in the central bank's toolkit for managing inflation and a lot of other things. They can impact consumer spending, investment, borrowing costs, inflation expectations, and other economic variables, making them a crucial component of monetary policy. And unfortunately, they also are hated by many Canadians because of the situation that we're currently in with very high interest rate costs. But in reality, the interest rates that we're seeing today were the normal before 2008 as a middle line interest rate was good for borrowers and savers alike. And I'm really thinking from seeing what currently 3 year to 5 year GIC rates being over 5%, it's in my opinion, and a lot of economic people out there, economists as they're called, are predicting that we will never see a 2% interest rate again, that we're going to be more in the 4% range in the years to come, which hopefully will limit asset bubbles like we've seen in the last decade or so, but also make it a better environment for savers and debtors alike. Anyhow, thank you for watching, and I appreciate it. Please hit that subscribe button. Hit the like button if you thought my information was useful. Share it on your social media if you think other folks would appreciate this information. And I hope you're all well and have a wonderful day.